is Mary Pearl Opariado, and I'm a course tutor for corporate financial analysis. In this session, we'll be analyzing the cash flow statement. Now, upon completion of this session, you should be able to use financial ratios to analyze cash flow statements and also perform an analysis of operating activities, investing activities, and financial or financing activities of a firm. This unit relates to the real analysis of the cash flow statement and all other related issues. And we will use the financial ratios to see how various activities of the company can be analyzed. The first financial ratio is the interest coverage ratio, and that is the ratio of cash flow from operating activities to interest payments. So in other words, it's cash flow from operating activities divided by interest payments, and this ratio is done to show the firm's ability to meet its interest payments using the cash it generates from its primary activities. So a higher interest coverage ratio is more desirable because it would show that the firm is able to generate enough cash from its operating or its core activities in order to meet its interest payments, and that is a good sign because it shows that the firm will be able to cover its interest payments for the accounting period. Also, the debt coverage ratio is the ratio of operating cash flow after interest by total debt. So the operating cash flow after interest divided by total debt, and this ratio indicates the extent to which existing debt can be redeemed at once by using the net cash generated from operations. So this particular ratio, the debt coverage ratio, is used to determine the solvency ability of the firm. So if the firm is very solvent, that means it is able to generate enough cash from its operating activities in order to settle its debts in the long term. And a higher debt coverage ratio is very desirable because you would want to make sure that your operations are able to meet or able to cover the debts that the company has in the long term. The dividend to operating cash flow ratio, that's the dividend divided by cash flow times 100, and this ratio indicates the share of cash from operations that is paid out in the form of dividend. So there are a number of investors who invest in businesses for several reasons. Some may be in for the capital gains, others may be in for the dividend. And now there are investors who are very interested in the dividend policy of the firm, and therefore they would want to know if payments will be made. However, this dividend to operating cash flow ratio indicates how much of cash from operations is being paid out to dividend. So you would want to know that if the higher the dividend to operating cash flow ratio, the more the drainage of cash from the business. In other words, it means that majority of the funds that are generated from operating activities are leaving the business. In other words, they are being paid as dividends to shareholders, and therefore if there are any investment activities that the firm may want to undertake in the future, the firm may not have enough retained earnings because most of the earnings or the cash it generates from its operations are being paid out as dividends. So you'd want to be careful when assessing firms in relation to their dividend payments and their cash outflows. So you want to maintain an optimum level of dividend to operating cash flow ratio in order to not pay out all your cash from operations as dividend, but you'd want to retain some to undertake profitable investments, which would also maximize the wealth of shareholders. Then we have the earning cash flow ratio, and that's the ratio of operating cash flow to operating profit multiplied by 100. And this ratio indicates the extent to which operating profit has been realized in cash. So a high earning cash flow ratio is very desirable, and it's always desirable because it indicates or it shows that the firm has a sound liquidity position. In other words, the current assets are more than enough to cover the current liabilities of the firm. and the firm is able to realize enough cash for its operating activities. Depreciation to cash flow for new assets is depreciation divided by cash flow for new assets times 100, and this ratio indicates the rate at which the business sets aside funds for replacing assets. So we know depreciation is calculated on non-current assets or assets that last more than one accounting year or financial year. So you'd want to know that there's these kind of assets experience, they depreciate or they lose value, they deteriorate or they become obsolete, and at a point there would be the need for replacement. So the rate at which you set aside funds for this replacement of assets is what this ratio helps to determine. Also, the cash return on total assets is the operating cash flow divided by total assets times 100. And this ratio is used to indicate the efficiency of asset utilization in generating cash. So how efficient are you able as a firm to use your assets to generate cash for the business? Now, there are other ways of analyzing the statement of cash flow, and that could be based on the main activities of the firm. So you'd want to analyze in the business or the performance of the business in terms of its operating activities, its financing activities, and its investment activities. Now, like we mentioned earlier, the operating activities has to do with the core mandate of the firm, the primary or the basic revenue generating activities of the firm. So it tells you whether or not the firm needs cash infusion or not. So if you're a firm that is into sale of goods or rendering of services, you would want to pay particular attention when you have increases in your account receivables, especially when you sell large portions of your inventory to your customers on credit basis, and then it takes a long time to pay, or there you have huge amounts of account receivable balance in your account or on your financial statement. That means there's a cause for alarm. Even though you have sold your inventory, you haven't received cash from it, and a lot of your working capital is stuck in inventory, sorry, is stuck in trade receivables. So you might want to review your collection procedures. Either you reduce your the number of days you give to your debtors to pay back the goods they have taken from you on credit, or you'd want to revise your credit policies or do a new bill, and maybe rather than giving your goods out on credit to your trade receivables or your customers, you'd want to offer a cash discount for people to attract them or to enable them to pay promptly in cash rather than always resort to credit purchases from you as a business. Also, when it comes to investing activities, at one glance you can tell whether or not the company is growing, and that would be that in a lack of investing activities means you are not able, or the business is not purchasing new equipment or assets, and make sure that either the funds or the excess money that are being generated from the business are being diverted away from the company, or the business is actually not making any growth or improvement in its operations. And the lack of investing activities can be a deterrent for new investors or prospective investors. Also, when it comes to analyzing financing activities, this section of the cash flow statement will also show you or would reveal to you the repayment of debts, the borrowing of funds, as well as if capital or new capital is being injected into the business. And it also shows whether dividends are being paid to shareholders. It would actually tell outsiders whether the company has grown in its financial strategies and how the firm or the stewards of the business are being able to manage the operations of the company in order to generate returns for their shareholders. And this is one way of telling if shareholders' wealth has been maximized or not. So in this session, we discussed how ratios can be used to analyze the statements of cash flow and how to analyze financial activities, operating activities, and investing activities of the firm. Thank you.